We've been hearing a lot about volatility. Are you looking for an investment opportunity that limits volatility? Are you looking for something that helps you minimize your exposure to market conditions? Maybe we have the answer at Palio. Let me talk to you a little bit about what we're about. Essentially, this is about investing in some of the privately owned, fastest growing companies valued at somewhere between 10 and 100 million sterling enterprise values. They will all be backed by institutional private equity houses, so they will have been through the fire of due diligence and the disciplines of having to report into a professional equity investor. We're looking to raise up to 250 million sterling, and we'll invest that over the next 2 or 3 years by cherry picking the best possible companies. This is our primary lending product. We'll cherry pick the best possible companies to include in our fund for our investors. Now, by way of a resounding endorsement, we've got cornerstone funding from EIF, an arm of the EIB, in essence a quasi-European governmental sovereign entity. And you'll have probably seen from some of the press that we're in the final throes of due diligence, having been one of 24 applicants for the UK government's Business Finance Partnership. We've just been finalising due diligence today, and as you can see, the government are looking to invest a meaty amount into our fund, which we're very happy about. I can bring you down the next couple of bullet points. How much money do we make for our investors? Well, at the gross level, we're looking to generate IRRs of approximately 19%, a little bit higher than that, but we prefer to under-promise and over-deliver at Palio. In money multiple terms, gross, that's 1.64. And net fees, carry and taxes, that's up to 14. Actually, our base case model today is showing about 14.5%. Not bad for a credit-led strategy, I would suggest. It's a LIBOR-linked product, so if you're looking for an inflation hedge, maybe you should look at Palio. Now, we've sized this market opportunity, and I'm not talking about Europe, I'm not talking about UK as a whole, but purely the UK middle market value companies, somewhere between 10 and 100 million enterprise value, 25 billion sterling over the next 5 years. That's not a small opportunity. And the final point I'd make about Palio is that we are not a re-sprayed bank. We're not trying to become a me-too player in this space. We have a number of key differentiators. Just introducing the team, you'll be glad to hear that, contrary to popular belief, this slide has not come from the files of the Metropolitan Police. But by way of a differentiator, we've been doing this for quite some time. I personally have been lending senior debt and mezzanine to middle market companies for 21 years this year. And that's one of our key differentiators. We are not practicing on investors. We've done this before, and we have tried and tested track records that have been fully due diligenced for investors to review. That's the team. So how do we get our returns? Bit of a busy slide. Let me draw out 2 key themes for you. If you have a look at the numbers opposite each of the coloured arrows, that sets out the arrangement fee pricing and the margin fee pricing on each of the main instruments. Senior debt, the grey blob at the bottom, mezzanine green in the middle, and a small sliver of junior equity, which forms part of our composite fund structure. Arrangement fees are very healthy. Why is this? Well, we've seen a permanent reduction of supply of capital in this space. Some of the most aggressive players here in the UK between 2000 and 2008 were Glitnir, Landesbanki, Kaupthing, Allied Irish Bank, Anglo-Irish Bank. You don't see many of them around these days. The other point I would draw out is if you have a look at the capital structure, the credit metrics are strong here. The senior debt to EBITDA here, the 23 million slug, represents a mere 2.66 times EBITDA, and that's historic EBITDA. Senior plus mezz is a mere 4.4 times on a leverage basis. And look at how much cash equity is in the structure. There's no funny paper money here or notional numbers. That's a real cash number, and the cash equity here represents just a tad over 50% of the capital structure. So attractive credit metrics, and good fees and margins generating that net IRR bringing us up to north of 14%. This is our favourite slide here. I think a question was asked of the previous panel. How do you compare the relative attraction of equities versus credit strategies? We start in the top right-hand corner. Preqin would have us believe that over the past 10 years, the average net IRR across the world for a private equity fund is 13.6%. But if you have a look at the horizontal axis, that comes with a whopping huge volatility of 19+%. You come down to the mezzanine asset class, the average IRR over the last 10 years was 12.2%. But look at the volatility. It's close on 10%. With the composition of our fund, we're generating north of 14% IRRs, with more than half of our fund in first lien senior debt products, enabling us to achieve those returns with a minimal volatility. The standard deviation we've computed at about 6%. So on a risk-adjusted basis, we think we offer investors a very compelling opportunity. And that's where I would leave, where I started. If you're looking to minimize volatility with very predictable returns, bearing in mind most of our income comes from the day one arrangement fee and the contractual margin income. This is a very visible, predictable income stream. There's our contact details. Please do take an opportunity to have a look at our website. There's a marketing brochure on there which will give you more insight into the strategy. Enjoy your drink. Thank you. Yeah, one of the questions is all about sourcing. Others have had problems sourcing such assets. Where will you find investments? Well, quite simply, the team that I'm working with have been doing this. As I said, we're not practicing on investors. We've been doing this for 20+ years. We're well known to the principal private equity players and the principal corporate financiers. The deal example I just shared with you is actually a live deal. It was done by one of our key relationship private equity sponsors, advised by one of the leading blue chip European corporate financiers. And I think it's an indication of the scarcity of supply of credit to this middle market space that both independently picked up the telephone to the Palio team and asked them to get cracking on the deal. So sourcing assets will not be a problem, and it's a function of our long-term relationships with the key private equity players and the key corporate finance players. I think one of the reasons why others have been having problems sourcing the assets is some of the teams we've met quite simply haven't been present in this market space for 20 years plus. Sure, they've been doing it for 5 years, perhaps even 10 years, but it's quite an easy decision if you're a private equity practitioner. You want to work with a player that you trust and have done deals with previously. You're not going to have that track record if you've only been dabbling at it for 5 to 7 years. The other question on screen here is, would Palio invest in unitranche mid-market debt? Well, we're a mid-market specialist. We're a provider of debt to middle market, but we are an originator and mandated lead arranger. We're not a provider of liquidity. We're not here to take other people's debt. I think essentially we're a leader. We prefer to trust our own credit judgment rather than rely on somebody else's. And in terms of the unitranche slice, it's very much a matter of labeling. The products that we offer will be very flexible. If a management team and advisors would prefer to see it labeled and structured by way of unitranche, we're very happy to do that. But in the interest of transparency, we're always very happy to strip out the individual components of our package. So with complete transparency, they can see where the fees and charges are. And the last question here is your fund being offered to offshore accounts? In essence, we're open to any investors. Very happy to speak to anyone.
Great.